Hey, everybody. Jason Krutzky from TrendSpider here. I want to thank you all for tuning in to this very special election event. I've really enjoyed getting to see what all of the other speakers have to say about their thoughts on the election and going forward after the election. I've learned a ton. I hope that you guys have too. But let's talk about kind of what my thoughts are and what we're seeing on the platform here, shall we? I'd like to start with perhaps a bold statement. When it comes to the markets, I don't think it really matters who wins the election. Sure, some things are going to change. Some sectors are going to perform better than others. Some new leaders will emerge and some current leaders will stop leading. But at the end of the day, all it takes is a quick look back through history to see that markets don't really care all that much who the president is. When we zoom into the SPX chart, the charts that I'm flipping through here, they show percentage returns per president over the last 50 years. Despite crisis after crisis, wars, inflation, scandal, pandemics, and turmoil of all shapes and sizes, every president over the last 50 years, except for George W. Bush, bless his heart, has seen positive returns during their term. So that's great, right? Markets are likely to go up no matter who wins. The problem with that statement is that there's no real alpha in it, right? As a trader, what I really want to know is what specific areas of the market should I be focused on? And if you want to identify what areas of the market might benefit the most post-election, the only thing that I could really think to do was look at history and see what's actually happened in the past. So that's what I did. I made a watch list of all the major index, sector, and industry ETFs that I could think of, and I went through them one by one to see if I could find any trends that really stuck out. The first thing that I stumbled on was uranium. Seasonality data on the URA ETF shows us really strong performance in December of election years and the January that follows. In fact, URA offers the highest average return out of all the ETFs I analyzed during these 2 months directly following the election. So that's particularly interesting to me for one key reason: AI. We all know that the AI narrative is more powerful than it's ever been, so it's interesting to see history lining up with the current state of affairs. We also know that AI proliferation is going to require a ton of power. And you've got big tech leaders currently investing in the space. You've got Sam Altman from OpenAI. He's investing in Oklo. Bill Gates is putting his money behind a company called TerraPower. Jeff Bezos has backed General Fusion. Google is supporting TAE Technologies. Microsoft have partnered with Constellation Energy. So clearly, uranium and nuclear energy in general is going to be a key focus regardless of the administration. So then the next step is to consider the effects that each candidate might have on the space. Now, admittedly, I'm no expert in this, but if Kamala Harris is elected, I'd kind of expect her administration to continue pushing the same agenda as Biden's: clean energy, sustainability, reducing carbon emissions. These areas of focus could all presumably boost demand for uranium. A Trump administration, on the other hand, would likely prioritize energy independence, right? Bringing it home with a focus on domestic producers and supporting private sector investments. So with those agendas in the back of my mind, I think there are a few key names that we should be focused on that could benefit regardless of who wins. The first one is Constellation Energy, kind of an obvious one, but I want to start here simply because of how strong it is. It's currently outperforming 99.2% of the names in the S&P 500. Looking at the weekly chart, it's currently finding resistance at a key level, the 1.618, the golden fib extension from the previous major swing high to low. That's going to be the obvious spot to gain. And then you could use, if you wanted, additional fib extensions to gauge targets higher. If we drop down to the daily, we see what started this leg higher as a huge power gap up on volume on the news that they had signed that deal with Microsoft, a 20-year power purchasing deal where they would be reopening 3 Mile Island to provide that power. Well, when it comes to these power gaps, in the best case scenario, the gap never fills. The price just continues to drift higher. So I think the key thing to watch, at least on these low timeframes, is simply that. The way that I prefer to track it is with an anchored VWAP from the gap up. If price stays above that VWAP, then the average buyer from the gap up is in the money and is supporting the price. If the price drops below the VWAP, then that could become resistance, and perhaps it's best to wait until price is able to reclaim it to establish new long positions. Now, it's also important to note, after that news came out, we saw quite a few analysts revise their average price targets to the tune of about 19% higher. The previous average target was 226 per share, whereas now it's about 270 per share, 269. That's essentially where we're trading at now. So that's something to, kind of keep in the back of your mind. Price immediately went to the average analyst target. The second name I want to highlight is Cameco Resources. Cameco is another one in the group that's looking pretty good. On the monthly, we see it's consistently found support at its 20-period SMA since it gained it back in November of 2020. I'm also keeping a close eye on this monthly bullish MACD cross. You're going to want to see them stick the landing here with that, really continue pushing momentum in the direction of the bulls. Fundamental performance has been solid. Revenue numbers have been increasing pretty steadily over the past few years. Back when price really gained that 20 SMA on the monthly, you see a clear relationship between revenue ticking up and the price moving higher. So I think you want to see that relationship continue. Also, seasonality trends support strength into the year's end, with November and December of election years historically bringing in high win rates and notable average returns, 7.65% and 8.7% respectively. So there's a convergence there between the ETF and the individual name. So now I've got an idea of the sector of the market that I want to be focused on directly after the election. But what about the first year of the new presidential term? The next idea that I had was to see if I could identify any trends in the year that follows an election. And in fact, I found a few. The first one was in Homebuilders, the XHB ETF. And what I found was that in the year following an election year, Homebuilders offer the most instances of monthly outperformance compared to all of the other assets that I analyzed. They have the highest average returns of any sector, specifically in 3 key months, in March, April, and July. Now, this is interesting to me for another key reason. Another thing that's obviously been top of mind for all of us traders are interest rates. Powell and the Fed just cut by 50 bips. The expectation is that they're going to continue to slowly cut over the next year or two. If they do stay on that path of cuts, then we got to expect that mortgage rates are going to slowly decline, which means an increased interest from new home buyers. The housing market has mostly been in a standstill lately. This could free it up. So now again, I'm no expert in policy, but generally speaking, I'd expect Kamala to be more focused on things like affordable housing, urban redevelopment, green construction, whereas Trump, I think, is going to be more focused on deregulation, which I have to assume would lead to reduced costs for developers. Maybe we can build more houses more quickly. So I think home builders definitely benefit no matter who gets elected. And there are a lot of great looking names in the space. You got Home Depot and Lowe's, both looking awesome here, pushing into new all-time highs. Lowe's is leading slightly. You've got home builders like D.R. Horton, Toll Brothers, and Meritage. They're all in these Weinstein stage 2 extensions higher. Lots of really good looks out here, but I want to look at 2 specific names. The first one is Lennar. Lennar is one of the largest home builders in the US, and with their focus on sustainable housing solutions, they're definitely going to benefit from any government subsidies that get distributed for low-income housing projects. So Lennar Corporation has really been on a tear for the past 2 years. It's currently outperforming 81.5% of its sector peers. It's consistently found support within that monthly 821 EMA cloud. This name has managed to recently gain the 200% Fibonacci extension from the 2022 high to lows. So to me, that is a key risk on or off level. Above 172, we want to be long. Below 172, we want to have a little bit of caution. Also, in late September, Lennar saw a wave of analyst activity, mostly buy or hold ratings, and post-election year seasonality trends point to March as the highest average return month for the name with a 6.83% average gain. So it's kind of confirming what we saw in that ETF seasonality as well. The second name that I want to highlight is slightly outside of the realm of the home builders. It's not actually a home builder name, but it's absolutely necessary to the process of home building, and that's Caterpillar. Now, Caterpillar has shown unbelievable strength this year. It pushed powerfully out of the long-term ascending wedge in February. It retested that breakout spot in August. It's making new all-time highs this month. However, 2 quarters of revenue misses in a row, as well as the expectation of EPS numbers to decrease over the next 2 quarters, could be providing a bit of a warning shot for bulls, at least in the near term. To add to that, relative performance is showing a clear negative divergence, with the stock weakening relative to the S&P 500 with each new high that it's made since 2023. When it comes to relative performance, you really want to see new highs in price correlating with new highs in RP. So this could be a sign that the name is actually weakening a little bit under the hood. We've also seen majority selling from government officials throughout this year's run-up. So these are all things to keep in the back of your mind when considering long positions on the name right now. But all that said, however, if the strength does continue into next year, the highest potential for positive returns in a post-election year on Caterpillar come in the early summer months of April and May. Now, going back to that bigger scale seasonality analysis that I was doing, when I focus specifically on sectors that offer just the highest win rates following or in the year that follows an election, I found that the most consistent performance was in 2 sectors: aerospace and defense and semiconductors. So let's talk about aerospace and defense first. The aerospace and defense sector, represented by the XAR ETF, shows strong post-election performance with a 100% win rate in 6 out of 12 months in the year following an election. Now, of course, defense is going to be super important under either administration. Under Trump, the defense budget reached $740 billion by fiscal year 2021. Under Biden, it ballooned to $850 billion by this year. So there's a lot of unrest out there these days. I can only imagine that these numbers are going to continue to grow under the next administration, no matter who is in charge. So let's look at a few key names. The first one that I want to highlight is a name that I don't personally hear discussed too often: Howmet Aerospace. Now, if you follow us here at TrendSpider, if you follow us closely, you know that we recently released a scanner that identifies CanSlim names. And this name, Howmet, happened to come up in that scan. It's got 10 straight quarters of year-over-year earnings growth. It's outperforming 99% of the S&P 500. This one is a monster, and analysts really seem to like it too. You've got a top target estimate of $125 from Deutsche Bank. On the other side of the coin, you've got a name like Boeing, who's really facing some challenging technicals. It recently broke below its 200-month SMA. It's now testing the ascending trend line from the COVID low. If this area fails, there's a large volume gap below that could act as a magnet for price. So we got to keep a really close eye on it. It's currently underperforming nearly all of the names in the S&P 500, and analysts are absolutely reacting as you would expect them to. All recent price targets have been revised down. However, if you're looking for a potentially bright spot post-election on Boeing here, the highest win rate and average return historically comes in May. The last name that I want to highlight in this sector is Lockheed Martin. For this one, bullish MACD crosses on the monthly seem to be the name of the game. They offer up big gains each time they've occurred over the last 5 years. So it's no wonder that we've been seeing so much buying from government officials over that same period of time. Now, Lockheed's recent period of strength has pushed its relative performance score to over 90, meaning it's outperforming all but about 10% of the names in the S&P 500. And if you're curious how this strength might fare post-election, we find that May offers the best opportunity for gains with a 100% win rate and an impressive 5.5% average return. Beyond the technicals, also, Lockheed continues to reward their shareholders. They recently raised their dividend by 5%. That marks 22 years of consecutive increases. So last but not least, let's talk about the semis. We see the exact same performance from the SOX ETF as we did with XAR. 6 out of 12 months in the year following an election have 100% win rates. Semis are critical for AI development, 5G technology, automobiles, modern defense systems. This sector is going to be a pivotal one regardless of administration. Under a Harris administration, we have to assume the semiconductor industry would likely benefit from support for sustainable technology and initiatives in AI, clean energy, 5G. Maybe we would see government incentives to advance these areas. In contrast, a Trump administration would likely emphasize domestic manufacturing and reducing dependence on foreign production. He would also likely provide tax breaks and regulatory easing to bolster US-based semiconductor facilities. So, green tech and innovation under Harris versus manufacturing independence under Trump. Let's talk through two key names. The first one, obviously, NVIDIA. After several months of consolidating and price filling the fair value gap created in May, NVIDIA appears to be starting its next leg higher, if you can believe that. You could see it's attempting to gain the 500% Fibonacci extension from its 2022 high to low. Unbelievable performance. Its relative performance score is nearly unmatched. It's outperforming 99.4% of the names in the S&P 500. And despite massive selling of over $700 million in shares from CEO Jensen Huang, analysts are as bullish as ever. Recent buy targets average $154 a share. Seasonally, if you're curious about that, NVIDIA's strongest month in the year following an election is May. It gives us an 86% win rate and an average return of 19.71%. Crazy. Last name I want to talk about here is Intel. It's been a tough road for Intel bulls. Undoubtedly, but the stock is trying to dig in exactly where it has over its many years at the anchored VWAP from its 1986 IPO. On the monthly, it's also showing a clear bullish RSI divergence in what appears to be a volume climax right at the lows. This is typical of what's seen at major tops and bottoms. In a show of confidence, you've got Intel CEO Patrick Gelsinger. He's also made some purchases this year. You don't see CEOs buying all the time, so when you do, it's worth it to kind of keep it. It's worth it to be mindful of it. So that signals that leadership is seeing potential value at these levels. The last little piece here, seasonality in the year after an election. It might take a little patience for seasonality to play out. The month with the highest potential for positive returns happens to be December. So maybe don't jump right into long positions on Intel, but keep your eyes on it. So as we've explored today, while the future remains uncertain, history has shown us that patterns do often emerge after elections. By analyzing these presidential cycles, seasonal trends, and sector-specific insights, we've identified areas of the market that could present significant opportunities based on the election's outcome. So by looking at the past, we've kind of positioned ourselves to capitalize on what could lie ahead. Now, some of these ideas might work. Some might not. We could get some huge surprise in the coming months that no one is expecting. So I do think that what's most important going forward is to have the right tools and keep an open mind. While I can't personally help you with keeping an open mind, what I can do is I can offer you a tool. Earlier, I mentioned CanSlim when we were talking about HowMat. And now I want to share that CanSlim scanner with you guys. If you're not already familiar, the CanSlim methodology was developed by legendary investor William J. O'Neill. He used the philosophy to identify stocks with explosive growth potential. And this scanner takes into account his requirements and finds stocks meeting that criteria right now. So as we move forward into this next phase of the market, don't just sit on the sidelines. With TrendSpider, you can take advantage of this CanSlim scan and all of the tools that I utilized in today's presentation to position yourself for success and capitalize on the best opportunities that emerge post-election. So with that, we're going to wrap it up here. I want to thank everybody for tuning in. I also want to give a very special thanks to all of our guests for so graciously giving us their time. If you liked what you saw today, you're interested in giving TrendSpider a try, we've got a great deal that we're offering this weekend only. And I'm about to sign off. So as I always say, happy trading, and we'll catch you guys next time.